All right, let's talk about the money machine. You know, the one that quietly powers our entire economy. We're going to break down how companies go from just a tiny idea to a global giant. And we'll do that by meeting the three key types of investment funds that make it all happen.
So, let's start with a really simple but super important question. Imagine you've got a brilliant, world-changing idea. But ideas, they're just ideas. They need cash to become real companies. So where does that first bit of money, that really high-risk cash, actually come from to get a company off the ground?
Well, the answer to that is a journey, and it has a name, the funding life cycle. It's basically the roadmap a company follows, from a sketch on a napkin all the way to becoming a giant on the stock market.
And that journey, it always starts small, like really small, with your own savings or maybe some money from friends and family who believe in you. Then, once the company starts to prove itself and needs more fuel to grow, the bigger players step in. You've got angel investors, then venture capital, and finally, these huge private equity funds. Each one of these steps means a bigger bet and a much, much bigger check.
And that final step on the timeline, the IPO, or initial public offering, that is a massive, massive turning point. For all those early investors, the angels, the VCs, the PE funds who took a huge risk years ago, the IPO is their payday. It's their big exit. But at that exact same moment, it becomes the main entrance for people like you and me, the general public, to finally get a piece of the action and invest in the company.
So once a company goes public, the whole game changes, and a totally different set of players takes over. Let's try to simplify this kind of complex world by meeting the three main types of money managers you'll find.
First up, we've got the mutual fund. Honestly, the best way to think about this is like the public bus of the investment world. It's heavily regulated, it's pretty safe, and pretty much everyone can get on board. It follows a set route, mostly investing in the big, publicly traded stocks and bonds that we all know.
Now, in complete contrast to the bus, you've got the hedge fund. This thing is a race car, a Formula One car. It's built for one thing, speed and performance. It uses really aggressive, high-risk strategies. We're talking everything from complex financial instruments called derivatives to crypto, all in the chase for big, short-term returns. But just like a race car, it is definitely not for everyone. It's exclusively for the wealthy.
And that brings us to our third player, the private equity fund. So if the mutual fund is a bus and the hedge fund is a race car, then private equity, or PE, is the powerful, rugged, off-road vehicle. It's designed to go where there are no smooth paved roads, no public markets. Its entire business model is to buy, fix up, and then sell private companies, often over a really long period of time.
So the crucial thing to get here is that these funds aren't just using different vehicles, they are playing completely different games with totally different rulebooks. And the key differences really come down to three things: who's allowed to invest, what kind of strategies they can use, and of course, how they get paid.
Which, brings us to a pretty critical question. We all know how to get on the public bus, the mutual fund. But who exactly gets a ticket to ride that high-performance race car or that powerful off-road vehicle? I mean, what does it actually take to get in?
Well, the price of admission is steep. In India, just to be considered a high net worth individual, or HNI, and even have a shot at investing in these exclusive funds, you need a minimum net worth of 5 crore rupees.
And oh, it doesn't stop there. On top of that 5 crore net worth, you also need to be making an annual profit of at least 1 crore. For institutions, the numbers are just astronomically higher. Plus, these funds are capped at just 499 partners, and they're not even allowed to advertise. They can only raise money through their private networks and referrals. It's a very, very exclusive club.
This table really lays it all out, side by side. You can see the first glaring difference right there under who can invest. Mutual funds are for the public. The other two are for that exclusive HNI club. Then, look at the focus. One sticks to public stocks, the others are playing with private companies and chasing flexible short-term gains. But the real kicker is the fee structure. A mutual fund charges a pretty simple management fee. Hedge funds and PE funds, though, they run on the famous 2 and 20 model. That means they take 2% of your money just for managing it and a massive 20% of any profits they make. That 20% is the real rocket fuel. It gives them a huge incentive to take huge risks for shot at huge rewards.
Okay, so let's tie all this together. Why does this whole system of exclusivity even exist? Well, it all boils down to this fundamental relationship between risk, reward, and the need to protect everyday investors. And here is a perfect example of that protection in action.
Mutual funds are legally boxed in. If they use complicated tools like derivatives, it's almost always just for hedging, which is a defensive move. As the source material says, you should think of it like buying insurance to protect the fund from losing money, not to make some crazy aggressive bet. So the trade-off here is crystal clear. Mutual funds offer lower risk, and in return you get more moderate potential returns. Hedge funds crank up the risk quite a bit for a shot at higher returns, and private equity, well, by investing in these unproven private companies, they're taking on the highest risk of all, but they also have the potential for the absolute highest reward.
So in the end, that exclusivity we've been talking about, it's not just some velvet rope to keep people out. It's actually a core feature of the system. It creates a special zone where sophisticated investors who can absolutely afford to lose their money are allowed to use these high-stakes strategies to fuel innovation, strategies that would be way, way too dangerous for the general public's retirement savings.
And that kind of leaves us with a final big thought to chew on. There's no doubt that this two-tiered system fuels incredible innovation and growth. It funds the companies of tomorrow long before they're ready for the public stage. But it also raises a pretty tough question. In a system where the highest risks and the absolute biggest rewards are reserved for an exclusive club, who really gets to share in the wealth that all that innovation creates?